Hi everyone, my name is Nikita Polishchuk. I'm the financial analyst of PhD Advisory Tax and Accounting, part of DP Group. In today's video, I'm going to talk about what is ESG and how it may affect the financial performance of your company. First, let me introduce our company, DP Group. In DP Group, there are 4 companies about which I'm going to talk in greater details on the next slide. The companies are Dendra & Partners Legal Counsel, PhD Advisory Tax and Accounting, Eastern Communication and Events, and Chance and Better Education. So Dendra & Partners Legal Counsel is our international law firm, which is made up of professionals coming from different countries around the world. And clients of the firm include both large industrial groups as well as medium-sized Italian, Chinese, and other enterprises. Among the practice areas of Dendra & Partners Legal Counsel are corporate and commercial law, legal compliance, M&A, environmental law, and dispute resolution, and many others. PhD Advisory Tax and Accounting is our international consulting firm which focuses on accounting, taxation, and finance. We provide services such as the full support of the back office activities such as bookkeeping, tax compliance, treasury, payroll. We also assist our clients with the financial supervision and providing them with the internal audit reports. We also assist our clients with the transactions related to M&A and other activities, as well as provide consulting on both personal and corporate level. Eastern Communication and Events is an international agency which specializes in social media management, digital marketing, PR, and event planning. And Chance and Better Education offers such services as short-term visits and senior courses, study abroad consultation, as well as language trainings. This slide shows some of our clients. And these are the contact information of all our offices worldwide in China, India, Italy, Vietnam, and the UAE. So for the topic of today's video, ESG and financial performance. So in today's video, I'm mainly going to focus on what is ESG and how it may amplify the financial performance of a company, or how failing to comply with it can actually deteriorate the company's value. I'm not going to be focusing too much on any specific numbers here, but actually would like to introduce these important topics to our viewers. So in the agenda for today is the following. First, I'm going to briefly introduce the concept of ESG and how it came about in the last century. Then we're going to focus on the 3 specific factors in the ESG. And lastly, I will talk about risks and best practices in order to adhere to the ESG principles. So what is ESG? Basically, ESG stands for environmental, social, and governance criteria, which are a set of standards for a company's operation that socially conscious investors use to screen and monitor potential investments. So ESG refers to the 3 essential factors in measuring the sustainability and the societal impact of the investment in a company or a business. And the analysis of these criteria is actually thought to better determine the future financial performance of companies, unlike the traditional factors such as risk and return. So now let me quickly talk about how this ESG came about. Traditionally, decisions on where to invest, where to put one's money, those decisions were based primarily on the concept of financial return and risk analysis. However, there have always been plenty of other criteria on deciding where to actually place your money. It was in the 1950s and 1960s that some of the vast pension funds, which actually were managed by the trade unions, they recognized this opportunity to affect the wider societal environment by using their capital assets. So for instance, in the US, some of these pension funds actually invested considerable amount of capital in developing affordable housing projects and health facilities. And actually this investment was not only beneficial for the local communities and had a very good societal impact, it actually also resulted in very nice return for those funds. Later, at the end of the 20th century, some of the world's biggest banks and investment houses actually began to respond to the growing interest in the ESG investment market. And they started providing number of sell-side services such as equity and industry and market research. And today it is widely believed that the development of ESG factors, actually, in consideration of in the investment analysis, is inevitable. There is more and more evidence towards a relationship between consideration of ESG and actually the performance of a business or a company. So ESG today has become a matter of practicality rather than simply philanthropy. Next, let me introduce the three components of ESG separately. The first one is environmental, which is, well, it's pretty self-explanatory here. Today, a number of issues that are discussed on the official state levels. One of them is, of course, the climate change and the threat of climate change. This slide shows just some of the most common, most observable problems, such as the greenhouse emissions, improper waste management, improper management of water resources, and the effect on the biodiversity on Earth. Next is S, so social. So social criteria actually look at the company's business relationship with its suppliers, its employees, local communities, and any other stakeholders. So first factor that I highlight here is diversity and gender equality. So the level of diversity as well as inclusion in the company's recruitment process and people management is actually becoming a greater concern for many investors and stakeholders. So there is growing perception that the broader the pool of talents, the higher the chance of finding the right and the most optimal person for the job. And there is an increasing awareness of this, and it has become something which is called the power of difference. Next is the human rights. Of course, this area of concern is widening and include such consideration as the impact on local communities, health and welfare of employees of a company, examination of the supply chain, and so on. Next is the consumer protection. Of course, especially recently, there has been increased assumption that consumers actually should have a right of a degree of protection when they communicate with your company, when they purchase things from a company. And this has become an increasing, it's going to attract a number of attention from investors and broader community. And finally is the animal welfare. So of course, such companies which are engaged into testing, for instance, the food of pharmaceutical companies, there are a number of activist groups which actually pay great attention to the animal welfare, and this is also something to keep in mind. And next is G, which stands for governance. Corporate governance covers the area of investigation to the rights and responsibilities for the management of a company. So it's boards, shareholders, and many various other stakeholders. Some of these only apply to bigger companies, but nevertheless, we are going to talk about these also in relation to small and medium enterprises. So of course, first is the management structure. The system of these internal procedures and controls, which makes up the management structure of a company, is important in the evaluation of actually the company's equity. Recently, there has been a greater focus of attention on the balance of power between the CEO and the board of directors, and specifically the differences between the two roles and the differences between the European and the US model, where in the US, it has been found that roughly 80% of companies have a CEO, which is also the chairman of the board, while in the European model, it was found that 90% of the largest companies have split the role of the CEO and chairman, which creates less conflict of interest. Next is the employee relations. Of course, it's important to create a very inclusive and very positive value in the company, but also to make sure that profit maximization doesn't just become, an ultimate goal, and other ethical considerations are not taken into account. Next is the executive compensation. This, of course, primarily relates to the larger public companies, and these days, companies are now being asked to list the percentage of bonus payments and the level of remuneration of the highest paid executives, as more and more attention is being paid towards this issue. And finally is the employee compensation. So besides the compensation of executives, equitable pay for other employees is a consideration of major governance in the organization. And this is in relation to equal pay for equal work, regardless of one's gender or any other affiliation. Okay, and next I would like to talk about ESG and responsible investing. So responsible investing initially started as a very niche investment area, which served the need of those who only wish to invest but wanted to do so within, ethically defined parameters. But it actually has become a much larger proportion of the investment market in the recent years. So just for instance, in 2019, the flows into the US sustainable funds were roughly 21 billion US dollars. By June 2020, the flows in the US sustainable funds reached $20.9 billion. By the end, the flows surpassed. By the end of the year, the flows surpassed $51 billion. And we could see that the statistics at the end of 2020, globally sustainable funds held 1.65 trillion US dollars in assets, which on the global scale is not the greatest amount, but nevertheless, this attracts a number of investors, and it's going to continue in the future. And one of the last things that I would like to talk about is the risks of ESG non-compliance. So from both the point of view of an investor and an investee. First, of course, ESG constitutes the financial risks of not adhering to the ESG principles. One scenario could be that, for example, conditions associated with the ESG are not sufficiently reflected in the price. For instance, the company has some non-compliance issues with several rules, regulations, laws, and this may entail both fines and the loss of major contracts with suppliers, with customers, and is very, very relevant in the pricing of company. Second is the reputational risk. So, of course, there is a very high risk if one actually buys a company in which serious, for instance, environmental pollution or human rights violations have been uncovered. And this is going to have an effect on both the acquiring company and the acquirer. And lastly is the legal risk. A buyer may risk inheriting some of the legal liability for historical offenses in the target company. For instance, some of the criminal liability or even things like liability for compensation of the employees which have left already. And finally, our recommendations is actually to have a process which is called ESG due diligence, which is essential in both buy and sell side transactions. It's very important to actually understand the risk profile and exposure and take preventive measures. And this is how companies of our group can actually assist you and your company or assist in the due diligence of the target company for the ESG issues. So our international law firm, Dana Partners Legal Counsel, can help with environmental compliance and legal due diligence. PhD advisor, tax and accounting provides services such as HR audit, as well as the corporate structure advisory. And finally, Eastern Communication and Events may assist with issues such as public relations and communications. And at last, ESG is more than just doing the right thing. It's actually about managing financial, legal, and reputational risks while staying on the path to long-term sustainable profitability. Thank you for your attention. If you have any further questions, please feel free to contact us at the email in the description below, or leave the comments in the comment section. Thank you for your attention.